Hey, welcome back to MedSnap 1 Minute. This is the episode 3 of the video series Finance for Mbbs students or doctors, where we are going to learn about mutual funds, different types of mutual funds, and the amount that needs to be invested in all the different kinds of mutual funds. I've been learning investing since the last 3 years and have been managed to generate a decent returns of 14 to 17%. A major chunk of my investments actually belongs to mutual funds. A lot of people want to invest in the stock market, but analyzing each and every company is quite a lengthy process. And not only that, throughout your investment process in that particular company, you need to continuously check the fundamental and the technical analysis of the company, which is a time-consuming process. But in mutual funds, the entire process is done by a fund manager, and in return, you pay a little bit amount that gets deducted from your investment amount to these mutual funds, and that is called as the base expense ratio. So for those individuals who do not have the time and energy to analyze each and every company, for them mutual funds is the best option. There are majorly 4 different categories of mutual funds. First, the equity mutual funds. Second, the debt mutual funds. Third, the hybrid. And fourth are the other kinds of mutual funds, which like the sectorial funds investing in a particular sector, like that of an IT, pharma, international funds, or certain tax saving funds. The equity mutual funds further can be classified into 5 different categories, like the large cap, mid cap, small cap, flexi cap, and the index funds. The index funds have already been described in my previous video, but if we talk about the large cap funds, they invest in those companies that have a huge market capital and are comparatively much more stable with less variation in the stock price. For mid cap, they invest in those companies which have a lesser market cap than large cap. They are comparatively more riskier than that of large cap, but less risky than small cap companies. Small cap companies are those which have the least market capital and they have the highest growth potential, but as well as large variations in the stock price. Flexi cap mutual funds invest across all the different kinds of market cap available, and index funds are those which replicate the index. There is a rule that if X is your age, then 100 minus X is the amount that needs to be invested in an equity mutual fund. After that, suppose your X is 20, suppose your age is 20, in that case 100 minus 20, that is 80%, should be invested in an equity mutual fund. After that, you can divide it equally among all the 5 different categories. That will be 80 divided by 5. Approximately 16% should be invested in across all the large cap, mid cap, small cap, flexi cap, and the index funds. Second is the debt mutual funds. Debt mutual funds are those which invest in stable assets like that of bonds or government securities. They are comparatively much more stable compared to that of equity mutual funds and provide a fixed return. Another type of mutual fund is the hybrid mutual fund, which is a combination of both debt and equity mutual funds. Further, they can be classified on the basis of the percentage allocation to equity and debt into balanced, which have equal proportion of equity and debt, aggressive, which have a 65 to 80% investment in equities, and conservative, which have a more investment proportion in debt mutual funds. After your 80% gets invested in the equity mutual funds, the remaining 20% can be divided equally between the debt and the hybrid mutual funds. Overall, if we talk about the percentage allocation, then 100 minus X, that is 80% for a 20-year-old person, should be invested in an equity mutual fund, where equal proportion 16% can be invested in large cap, mid cap, small cap, flexi cap, index funds. Further, 20% can be divided 10% into debt mutual funds, 10% into hybrid mutual funds. Further, it also depends upon your risk-taking ability. If you are someone who is younger, who do not have a dependent family on them, then they can invest larger proportion in high-risk stocks like that of the equity mutual funds, especially in the small cap and the mid cap funds. But if you're someone who does not want to take that much risk, in that case you can invest more amount in the large cap funds and index funds compared to that of the mid cap and small cap funds. So for your homework, explore all the available mutual funds on Google or in your Demat account by searching for the different categories of mutual fund and get an overall idea. Next week, I will be telling about how to exactly select a mutual fund. If you haven't watched my previous video, you can click on the video that is about the index funds, and if you want to learn stock market from an expert detailed step by step, then you can click on the link in my description for the Techno Fund Investing Silver membership.